You're listening to Capital Topics, episode number 83. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investors. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In today's episode, we break down the key stock market statistics from 2025 and we unpack the biggest lessons the year taught investors. Enjoy! Good morning, James. How are you today?
François, I'm excellent. I had great Christmas holidays.
I had too. So on that, before we start, since it's our first podcast for the year, I would like to wish our audience a happy, healthy, and prosperous year in 2026.
Yes, indeed, François. Our very best wishes go out to all our listeners and their families, wishing them, again, all the best of health and happiness in the new year.
Now, as we usually do for the first episode of the year, we will look at what happened in the markets and the economy in 2025, a year that frankly defied expectation at almost every turn. If we had told our listeners at the start of the year that we would see sweeping tariffs, a record-long U.S. government shutdown, sticky inflation, geopolitical turmoil, and a constant tug of war between optimism and fear, I think that our listeners would have predicted a very rough year for the stock markets.
Yes, absolutely, François. I mean, I published a blog in December titled Our Best Advice of 2025. And that's sort of the lessons that we want our listeners to take. So this blog summarized, again, what we feel what you could take away from 2025. And number one was ignore the pundits and their forecasts. So again, the narrative heading into 2025 was dominated by caution. We just finished 2 years of double-digit returns. Analysts were warning about stretched valuations, slowing growth, and the possibility that the artificial intelligence boom had peaked. And yet, when the dust settled, markets delivered another year of strong double-digit returns. In fact, a third year of double-digit gains for the U.S. and Canadian stock markets and international markets. So results, again, very few investors saw coming, and that proved once again, staying the course is the right thing to do.
Totally, James. And even more surprising was the story here in Canada. Despite all the doom and gloom headlines surrounding tariff and the constant anxiety about how they might hit our economy, the TSX index quietly delivered one of the strongest performance in the world. It's a reminder once again that the markets and the headlines often tell very different stories.
Well said, François. Investors should never manage their money based on headlines. So today, as mentioned earlier, we're going to look at exactly what happened in the global markets and the economy. Most of the performance data points we will be referring to in today's podcast can be found on our market statistics page. This document is available on our Capital Topics website in the resources section, or you can find it directly on our team's webpage on the PWL Capital website. We believe that this market statistics page is an essential tool for our listeners to review and assess the performance of their own portfolios.
Totally. And now, before we discuss the performance figures for last year, let's look at what happened on the economic front.
Okay, François. Well, when you look back at 2025, we can say that the economy kind of muddled along, cooling somewhat, but not collapsing. Inflation kept drifting lower in both Canada and the U.S., but it did so at kind of different speeds. In Canada, inflation continued to drift lower throughout the year, again, in a very uneven way. By the end of the year, it stood at 2.2%, and this level of inflation is fairly close to the Bank of Canada's 2% target. So this gave them, at the Bank of Canada, the leadership, enough confidence to start cutting rates earlier and more aggressively than the U.S. Fed. So during the year, the Bank of Canada cut the overnight rate 4 times, from 3.25, ending the year at 2.25.
Exactly. The U.S. got there more slowly. The inflation remained sticky. So the Federal Reserve took a more cautious approach, let's say. They still cut rates 3 times from 4.5 to 3.75, but they made it clear that they weren't declaring victory since inflation rate remains above target of 2% at 2.7%. And of course, all this played out against the backdrop of President Trump publicly pressuring the Fed to cut faster. But Chairman Jerome Powell, however, held his ground, insisting decisions would be based on data and not politics.
Well, again, typical Trump interference. I think now let's have a look at what happened in the European economy. Euro area inflation fell much more sharply, and it currently stands at the European Central Bank's 2% target. Again, it was due to weaker growth in Europe. The European Central Bank had more incentive, therefore, to lower rates faster. They cut rates 4 times. They started at 3.15% and ended at 2.15%. So rates close to Canada.
Yeah, correct. On the labor market front in Canada, unemployment drifted higher during the year to finish at 6.8%. In the U.S., the labor market saw a similar cooling, with unemployment finishing the year at 4.4%, which is still healthy historically.
Okay, so let's tie it all together, François. Looking at GDP growth, the U.S. economy surprised almost everyone with several strong quarters. And again, the last quarter showed a healthy growth rate of 4.3% annualized. In Canada, the growth rate was more modest, but again, we avoided a recession. The GDP contracted in the second quarter, but rose again in the third quarter at an annualized pace of 2.6%.
Yeah. So in resume, 2025 wasn't a boom year, but wasn't a bust year. Inflation cooled, central banks eased, labor markets softened but held, and GDP growth continues but at different rates.
That's correct, François. Now, that being all said, let's now look at the performances in the bond market.
Well, James, Canadian short-term bond index finished the year up 3.9%, benefiting from falling yields and the Bank of Canada rate cuts. As for the broader universe bond index, which holds longer-dated bonds, the picture was positive as well, though a bit more muted as it returned 2.6% for the year.
That's right, François. Bonds didn't steal the spotlight in 2025, but quietly, they did their job. They provided stability and generated income.
Correct, James, and that's exactly their main role in the portfolio.
Okay, François, now let's look at what happened in the stock markets.
Okay, James, without going into the specific details of what happened during the year, let's just remind ourselves of how 2025 was just filled with noise, fear, and uncertainty. Every month seemed to bring a new reason to worry.
Exactly, François. We had wild swings between risk-on and risk-off sentiment. Investors debated whether artificial intelligence was a bubble, whether tariffs would derail the world economy, whether inflation would perk up, and whether the labor markets would crack. But yet, through all of that, the recession everyone predicted never materialized.
And that's a key point, James. Through all the ups and downs, investors who stayed the course prospered. Those who tried to time the market, who jumped out during the April sell-off, or who hesitated because valuations looked high, missed the strongest parts of the rally. It's a reminder that markets climb a wall of worry. Headline screams, emotions run high, but the long-term discipline wins.
Well, François, like I said in my blog of Best Advice of 2025, last year was a masterclass in how emotions can mislead investors. I recommend our listeners go back and review our last podcast, number 82, on behavioral biases. This will help them really understand how emotions can impact portfolios.
Yeah, totally. So let's now look at the performance for Canadian equities. In late 2024, many investors wanted to go all in the U.S. market, and you could understand why. The U.S. market had dominated for decades. They had outperformed Canadian equities by more than 6% annually for the last 10 years. In addition to that, with the prospect of tariffs hitting the Canadian economy, there were discussion and fears of capital flight, job losses, and of productivity crisis. The prospect for Canadian equities were not bright, but Canada shocked everyone. As of December 31st, the S&P TSX Composite Index was up 31.7%. It almost tripled the Canadian dollar return of the U.S. total market index.
Well, yeah, I mean, Francois, if you look at that, that's an extraordinary return by historical standards in relation to the U.S. market. But look at Canadian small caps; they returned a whopping 50.3% last year. I mean, that's
Wow.
not an error; that's the actual return, and it
Mhm.
reinforces something we've said for years: returns often come in short, unpredictable bursts. If you weren't invested, if you were waiting for the right moment, you missed it. And missing a year like that is incredibly hard to recover from.
Exactly, and that's why diversification isn't dead, it's alive and well. Not only did small cap stocks do well, but so did large and mid cap value stocks with a performance of 35.8%. You remember the difference in performance between US and Canadian equities for the last 10 years I mentioned earlier? Well, it was 6% annually as of the end of 2024, sorry. Now, with the strong performance of Canadian equities, the gap between the two was only 1.5% annually at the end of 2025.
Well, that's an incredible turnaround, Francois, but it's a little bit of data mining because you're taking a point at which the Canadian market did so much better. But
Oh,
that
yeah, totally.
1 year impacts the full 10-year cycle. And so the 10-year performance for Canadian equity is 12.7% compound, and it's 14.2 for U.S. equity. Now, keep in mind, this is impressive, but, when you consider the U.S. stock market returns over the past 10 years have been massively influenced by the returns of the Magnificent Seven stocks. So Canada doesn't have Magnificent Seven. So, François, can you really explain why Canadian equities have performed so well over that period?
Well, James, the three main sectors of the S&P TSX index, which are financials, basic materials, and energy, performed well last year, and together they represent roughly 66% of the index. But out of these three sectors, the one that stood out was basic materials with a performance of, hold on, James, 100.6%. That sector, which represents close to 19% of the index, benefited from the rush into gold and other metals by nervous investors looking for a safe haven due to uncertainty in the global economy. The impact was even greater in the small cap as that sector climbed 137.6% during the year.
Well, Francois, after so many years of Canadian stocks underperforming the U.S., this again goes to show the importance of diversification and sticking to your plan. Again, patience pays off. We've seen it in 2025. So, François, what's your take on gold's performance in 2025? And let's maybe address the issue of Bitcoin and other cryptocurrencies.
Well, James, gold obviously had a very good year in 2025. It was up roughly 65%, and it reached a record high per ounce, driven mainly by geopolitical uncertainty, a weakening US dollar, and other factors. As for the Bitcoin, it struggled somewhat. It lost 6.3% in US dollars for the years, closing at in US dollars 87,506 after peaking above 120,000 in July. Their performance, and especially for gold this year, does not change your view. They are speculative assets, not investments. Buffett said it once. I could not find the exact quote, but essentially he said that gold and Bitcoin don't produce cash flow. They don't innovate. They don't generate earnings. Their price depends entirely on what someone else is willing to pay for them.
That's exactly right, Francois. It's a piece of metal, so it's only what somebody's willing to pay for it. So you got to expect that there's going to be more fear or bigger fear coming in the future to justify it having a higher price. So again, it's a speculative asset. On paper, it is easy to believe that you can make money from gold and cryptocurrencies, but there's no real way to value them because they don't generate, like you said, cash flows. And so we feel that they are speculative investments and they don't make sense for most investors' long-term portfolios.
Exactly. Productive assets build wealth, speculative assets build headlines.
Well, indeed. So now what about U.S. equities, François? What happened there?
Well, James, although the US equities lack Canadian equities, and as you will see later, international developed and emerging markets equities, however, they still had a decent performance since the US total market index increased 11.9%. That's in Canadian dollars. In US dollars, that performance was somewhat stronger at 17.2%. The difference in return is due to the US dollar depreciating versus the Canadian dollar during the year. Unlike in Canada, small cap and value stocks continue to trail their counterparts with performances of 7.7% and 10.7% respectively. That's also in Canadian dollars.
Okay, so am I right, François, that for the third consecutive year, technology and communication services stocks were the primary drivers of returns in the U.S. market?
You're right, James. The artificial intelligence boom didn't slow down, and if anything, it accelerated. Companies poured billions into AI infrastructure, cloud computing, and automation. About 7 percentage points, or roughly 40% out of the 17.9% return of the S&P 500 index came from the tech stocks. And another 3.1 percentage points, or 18%, came from the communication services. So nearly 60% of the market's gains came from just two sectors. And when you zoom in even further, it gets even more concentrated. NVIDIA and Alphabet, alone with their strong performances of 38.9 and 65.2% respectively, contributed more than 2 percentage points each to the performance of the index. Combined, they accounted for more than a quarter of the performance of the total market last year.
That's incredible, but we've seen this before in capital market history, with IBM in the late 1960s, where you get the concentration in a few stocks. But NVIDIA is now a $4.7 trillion market cap company, and Alphabet, the owner of Google, is close behind. It comes in around $3.9 trillion. In market cap. I guess, that's an $800 billion difference. I said it was close behind.
Yes.
I guess we're being desensitized to billions and trillions. So some of these Mag 7 stocks are worth more than the whole stock markets of some developed countries, and even one as big as the UK stock market.
Mm-hmm. Now, to be fair, James, to come back, market breadth did broaden a bit in 2025. All the sectors of the S&P 500 index and 64% of its constituents had positive returns last year.
Yes, well, that's really good news to see it broadening out, François. We can't ignore the fact, though, that the mega cap stocks still carried an outsized share of the load, even with broader participation from other sectors and companies. The Mag 7, or the Magnificent Seven as they're known, which still represents about a third, 35% of the S&P 500. It remained the gravitational center of the market with an average performance of 21.9. Their earnings power, their scale, their dominance in AI kept them in the driver's seat, in our opinion. So to be more accurate, François, we would say, though, that the Magnificent Seven became the Magnificent Two in 2025. That is to say, only two members, NVIDIA and Alphabet Google, exceeded the S&P 500 benchmark return. So as you stated earlier, that those were NVIDIA at 38.9 and Alphabet up 65.2%. Again, all that's in US dollars.
Yeah. But what's important here is I think that investors need to be aware of this concentration. On one hand, having exposure to the winners has helped generate a significant outperformance by US equities over the long term. But on the other hand, you don't want your entire portfolio tied up in a handful of companies. It's a balancing act and one that requires discipline.
You're absolutely right, François. And a great example of that was the Danish stock market that was down 11.7% in 2025, despite, as we'll see a bit later, global stocks being up. The stock market was massively overweighted to one stock, Novo Nordisk, maker of the weight loss drug Wegovy and the diabetes drug Ozempic, and that stock had dropped significantly. So we should remind our listeners that concentration alone isn't a crash signal. Many countries have even more concentrated markets and still deliver strong returns. Historically, the relationship between concentration and future returns is said to be statistically insignificant.
Correct. But valuations, however, are different. High valuation can mean lower expected returns. The Mag 7 currently have an average price earning ratio, a PE ratio of 68. This is way above the long-term average of 20 for the S&P 500 index. This said, the other 493 stocks in the S&P 500 index have a PE of 28, which is nowhere near that of the Magnificent 7.
Yeah, but as a reminder to our listeners, valuations don't predict the future. High valuations can be followed by high returns. The U.S. stock market has proven that repeatedly. So valuations, again, don't help you time markets.
Mm-hmm. James, before we move on to international equities, we can't forget the tariff drama. When the U.S. announced sweeping tariffs in April, markets tanked. It was one of the sharpest sell-offs we've seen in years.
François, if you told me on April 3rd that the U.S. stock market would finish the year with double-digit gains, I would not have believed you. The market was flirting with bear market territory. We're down almost 19% from its peak earlier in the year. Investors were panicking. The headlines in the financial media were brutal. And then almost overnight, boom, the narrative and the psychology in the market flipped.
Yeah, totally. Yeah, when President Trump paused tariff, markets exploded higher. April 9th became the biggest one-day gain in 17 years. If you bailed out on April 3rd, you missed one of the most powerful rallies of the entire year. The S&P 500 on that day rose 9.3%.
Yes, on that day alone. And that's why market timing is so dangerous. The biggest up days often cluster right after the biggest down days. So also, no one could have predicted that President Trump would put a 90-day pause on the tariffs.
Totally. Now let's look at international developed and emerging markets. Surprisingly, as for Canadian equities, the U.S. tariffs did not negatively impact performance for international equities. International large and mid-cap stocks had a performance of 25.3% in Canadian dollars last year, and in domestic currency, a solid 20.6%. Small cap and value stocks also did well, returning 25.9% and 35.8% respectively. As for emerging countries, large and mid-cap stocks fared even better, returning 28.3%. That's in Canadian dollars. If we look at country-specific performances, it's interesting to note that countries explicitly targeted by U.S. tariffs like Mexico and China performed well last year with returns of 48.2% and 25.5% respectively.
I mean, that's really counterintuitive, François. You know, we thought Trump with his tariffs would be killing the countries he was targeting. But again, it's a very interesting point, and it reinforces our view that investors need to stay diversified, stay disciplined, stay invested, avoid the headlines when making investment decisions. And so before we wrap up, though, François, we really have to talk about uncertainty, because that's the one thing that never goes away.
Yeah, you're right, James. Uncertainty was plentiful in 2025, but now as we enter the new year, it's no different. Look at this situation in Venezuela and Iran, global political tension in the Middle East and in Ukraine, protests in the US, and continuing economic instability around Trump's tariff. It's just a reminder that geopolitical risk is always part of the landscape, and events like that are unpredictable. They're sudden, and they push us to react emotionally.
Yes, but markets have always lived with uncertainty. Always. There has never been a year when everything was, quote, calm and predictable.
And yet, James, markets adapt. They move forward. Uncertainty isn't the bug, it's a system, and it's the price of admission for higher, longer returns.
I completely agree with that statement. Again, 2025 is a reminder that markets don't move in straight lines, and they don't follow the headlines.
Exactly. Staying invested, staying diversified, and staying disciplined to your long-term goals paid off again. It may sound as if we are repeating ourselves, but as our good friend Jason Zweig from the Wall Street Journal once said, and I quote, "That's because good advice rarely changes while markets change constantly. The temptation to ponder is almost irresistible, and while people need good advice, what they want is advice that sounds good."
Well, that's very well said, and it's a great quote. I wish I could write like that. Unfortunately, people are influenced by the noise of the moment, and so if you say something as an advisor that sounds good in the moment, again, that is, pandering. And we as advisors want to wear the advisor hat, not the facilitator hat. So to conclude, the story of 2025, in a nutshell, uncertainty everywhere, resilience everywhere, and markets that rewarded patience over prediction.
Great. So on that note, we'll conclude. Thank you, James, for sharing your thought and expertise again today.
That's my pleasure, François.
So that's it for episode number 83 of Capital Topics. Don't forget, if you'd like to submit questions or suggestion for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on February 18th. In the meantime, make sure to consult the Capital Topics website for our latest blog posts. Thank you, and see you soon.